Hello guys, this is Rydon Academia, and today we are looking at the concept of depreciation in accounting. Okay, as you can see on your screen, depreciation can be defined as a reduction in the economic service potential of an asset as a result of wear, tears, usage and passage of time. Okay, so the reduction in the economic service potential or the reduction in the value of the asset, you can use any of those words. So the wear, tears, usage and passage you are looking at are the causes of depreciation. Okay, depreciation can also be defined as a permanent and continuous decrease in the quality, quantity and value of an asset. Yes, as your assets are being used, as resources are being used, the quality tends to reduce, and quantity for some assets like your nails, copper, etc. tends to reduce. Okay, and also the value, which could be financial or material. Alright, so when our fixed assets are sold, the part of the cost that is not recovered is what we call depreciation. So when we sell fixed assets after a period of usage, we sell it at a value called the scrap or residual value. But that value is not really at the full cost of the asset, because since we believe that the asset depreciate, that means the value reduce. So the scrap value is a lower amount to which the asset is sold. So the part of the asset that was not covered from the cost, that is our balance, when the scrap value is deducted from the original cost, is what we term our depreciation. Now we have reasons for depreciation. Number one, since depreciation is a charge against profit, the tax to be paid on the profit by the firm will be reduced. Okay, so these are one of the many important reasons why we provide for depreciation. Alright, so the profit of the firm will be reduced because depreciation is charged against the profit. So it is charged as an expenses, meaning profit for the year will be reduced, and also tax is paid on profit. So the business now enjoy maximum tax benefit when depreciation is charged, because the amount to be paid now will be lesser compared to when there was no depreciation charge. Are we following? Now the second reason why we provide for depreciation is that the amount charged as depreciation can be used for the replacement of the asset at the end of the useful life. This is one of the basic reasons why firm provide for depreciation. Assets that involves high amount of capital or high amount of purchase, okay, that is costly asset like big machines, etc. Now a company to buy it at all at once that may really affect the company or even lead to bankruptcy of the company. So what company does that they set out yearly from their profit to provide for the purchasing of those assets, okay, so that it will not just take them by surprise. Alright, so the third reason why we provide for depreciation is that it follows the matching concept. Now our matching concept holds that our expenses should be charged against the revenue as at when due. Alright, so every year we split the amount of or the cost of the assets into amounts that can be charged against revenues every year. We charge them as expenses, like I said. So that's the matching concept. We charge those amounts as expenses per year against the business revenue. Okay, number four, we arrive at a profit figure which can be compared with a similar business which is not having the advantage of owning the asset as the business charging depreciations. Now we have large firms, we also have smaller firms. Now our large firms, they have high amount of capital, so they are able to get more machines, more equipment compared to smaller firms. And because our large firms have enough capital, enough resources, they produce at a low cost rate, okay, at a low cost rate compared to the smaller firms. So a large firm charge depreciation so that the cost of their goods can be slightly equal to that of lower firms, and so that the smaller firms don't get chased out of the market or they don't get frustrated due to high prices that occurs as a result of unavailability of resources. So large firms charge depreciation so that it can balance off for that of smaller firms. Alright, number 5 says it enables the business to measure the degree of forecast in relation to estimating the amount of depreciation. So those are the various reasons why we provide for depreciation. Now, in calculating depreciation, there are various factors we consider. We try to look at them when calculating our depreciation. The first factor is the original cost of the asset. Now, your original cost refers to the amount that is used to purchase the asset, as well as the other amount that was used in installation, carriage, inward, etc. You don't just charge an original cost based on the amount of purchase alone. Please take note of this. The original cost is not just the amount used in buying the asset alone. It covers also the amount used for installation. It covers the amount used for carriage, so that the business can have a proper record. Alright. And number two factor to consider is the estimated value. Now, this is your scrap value or your residual value. That is the amount that the business realizes after you have sold the asset after a period of usage. Okay, when the asset is sold at the end of the useful life, the money that comes to the business is what we call residual value or estimated value, and that amount is usually set by the business. Okay, it is the business determine how much they will sell this at the end of its useful life. Now, the third factor we consider is the estimated useful life. This also is determined by the business. That is the amount of years that the asset is to last in the business, the amount of years that the asset is to be used in the business activities. So that also is determined by the business. Alright, and the fourth factor we consider, as you can see on your screen, is the method of depreciation. That is the method of calculating the depreciation. There are various methods that different firms managers chooses to use, and this also can affect the depreciation calculation. It's also a factor that can affect calculation of depreciation. So quickly, we are going to look at the various methods of calculating depreciation quickly. Number one, we have the straight line method. I'll just run through this quickly. We have the straight line method. We have our diminishing or reducing balance method. We have the annuity method. We have our sinking fund method. We have our retirement and replacement method. We have our sum of the year digits method. We have our depletion unit method, insurance policy system evaluation method. There are various other methods actually, but today, for the sake of this course, of this tutorial, I will be treating three topics with us, which are the straight line method, the diminishing or reducing balance method, and the sum of the year digits method. So now we're going to switch over to our tutorial calculation proper.